In March, we crossed a hard-to-imagine milestone, the one-year mark since the World Health Organization declared a pandemic. Life with COVID-19 has provided daily reminders about the unpredictability of just about everything. I'm Mark Kinney, Chief Investment Officer of Newport Private Wealth, with this first quarter update. I won't linger on the unpredictability that remains, from economic and market conditions to the future of how we live, work, and play. What I am certain about is our commitment to our disciplined investment process. The balance we strike between risk and reward to earn steady returns is proving itself out. We certainly needed that discipline and patience to ride through the narrow market leadership of 2020. But following the upswing in our performance in the fourth quarter, we've been rewarded so far in 2021 as well. We've had a sharp eye on the right opportunities and reinvested in smart managers that we know and trust. The result is some excellent new commitments and strong performance across our mandates in both relative and absolute terms. The investment themes we identified and acted on in recent years have been playing out. Specifically, the bond market is behaving as we'd expected and warned. In the first quarter, 10-year yields in Canada more than doubled to 1.56%, resulting in a loss of just over 5%. The hit to a typical balanced portfolio with a 40% bond weighting was about 2%, but as we only had about 5% invested in bonds, our portfolios were largely unaffected. We protected capital and earned better returns from our other sources of yield. Our diversified portfolio of mortgages, income-producing real estate, and private debt is producing higher yields, about 6% on average, with less interest rate sensitivity than bonds. Our mortgage component continues to perform well. Our managers can be credited for their strong underwriting skills, careful use of leverage, and avoiding the problem areas like hospitality and enclosed malls. We'll look to add to mortgages if we can. Ideally, we'd like to get them back to a 7 or 8% weighting, up from 6% currently. It came down because we've had capital returned to us and new opportunities that meet our stringent standards have been scarce. It's the same story with income-producing real estate. Our multifamily residential portfolio in both Canada and the US has stood up very well under the tough conditions of the pandemic. Rent collection and occupancy rates remain high, well above industry averages. We plan to maintain our current weighting of about 9% in real estate. That means adding new properties with the capital we regularly get back from rental income and asset sales. Private debt, which consists of loans to private companies by specialist lenders, is doing exactly what we thought and hoped, even under the most trying conditions for many businesses. Our managers took a defensive posture when the pandemic hit and adopted the safety features built into their loans. As a result, they've continued to deliver returns in line with target. The modest unrealized write-downs taken in the first half of 2020 have largely been reversed and will continue to improve in the coming quarters. That's a strong validation of the manager's investment approach and underwriting skills. During the quarter, we committed an additional $25 million into private debt to reach our target weighting of 8%. This amount included a new investment in a European mandate with a proven manager. The commitment allows us to diversify the portfolio outside of North America and into the less mature and fast-growing European market. We think there's more potential upside there, as less competition means better terms and higher yields for investors. The net result of our diversified yield strategy is best seen in the Newport Yield Fund. It was up 2.7% in the quarter, whereas the Canadian bond index was down 5%. Going forward, we're not concerned about the volatility of interest rates, and we don't care about the low returns in bonds because we're sourcing higher income elsewhere. Many of our yield investments are based on floating rates, and most are shorter duration. So if interest rates do rise, we'll participate, and we don't have a lot of term risk. We're sitting in the right position for a moderately rising inflation and low interest rate environment. On the public equity side, our portfolios have benefited from broader stock market participation, which in the last 6 months has rotated away from a handful of mega tech stocks into cyclicals that benefit from a rebounding economy. This includes industrials, real estate, financials, and energy. During this period, our North American and global growth managers outperformed their benchmarks by an impressive margin. The capital allocations we made last year when the pandemic first struck also paid off. Twice we've deployed more cash into our Canadian high-yield equity strategy with great results. And the manager's picks within the depressed parts of the economy, energy and real estate, have done very well. Those sectors helped to propel the TSX to post the strongest returns in the major world markets in the first quarter. With public equities now representing 46% in a balanced portfolio, we're fully invested. That's as high as it's been in a long time. It's a result of our putting cash to work and capital appreciation off the market bottom last year. We'll maintain this weighting unless there's a correction and then add opportunistically. Where we will and have been making adjustments is in the market mix. We've been increasing our international exposure while also favoring small and mid-cap sectors over large cap at this stage of the cycle. To that end, we initiated a new international small cap mandate with an existing growth manager in the first quarter. Smaller, underfollowed stocks have started to recover faster than large caps, and this trend should continue with the reopening of the global economy. The focus on Europe and other international markets is also timed right. Those markets didn't have a run-up like the US and have lagged over the last cycle, so we can use a buy low strategy to good effect. With both the international equity and our European private debt mandate, we have the advantage of a stronger Canadian dollar at our backs. The timing of moving money out of Canada when the loonies had a decent run is another positive. As we've said many times that bonds are overvalued, stocks are certainly not cheap either. And so just as we have multiple sources of yield, we have multiple sources of growth, including private equity, infrastructure, and real estate. An exciting new allocation is a private equity commitment we made with a manager with whom we have a 15-year track record. The investment is in companies in the early stages of digital transformation. We believe that technology is going to drive every business in every industry, and we want exposure to the businesses or the transformers in each of those industries. It's our fourth investment with this manager. They've proven their ability to build new opportunities successfully, including through difficult times when needed. Returns for the previous funds have been in the mid-teens, and the target is to continue in that range. This tactical, small, and strategic mandate has all the elements we like, with both financial and operational skills driving it. The alternative part of our portfolio is going to be very important in this coming cycle. We've spent years building it out with both the managers and the strategies, and are well diversified amongst them. The entire portfolio is fully developed, and we've cultivated managers who've been tested in different environments. We have a high degree of confidence in our managers and feel good about how we're positioned. Before I wrap up, I'll say a word about inflation because I know the question comes up. Certainly there are some inflationary pressures out there. We've got massive government spending, easy monetary policy, and supply chain disruptions that are pushing up prices for certain goods. When the economy reopens fully, consumer demand will explode. However, there are just as powerful forces for deflation at work: technology, demographics, globalization, and millions still unemployed, making a wage price spiral difficult in the short term. So we're not terribly fussed about inflation in the next cycle. We believe the interest rate rise and inflation trade-off will be managed carefully. That said, we're always watching for warning signs and will respond appropriately if we see them. As we navigate the shutdowns and race to inoculate, we're comfortable that we're in the right space. We're confident we're positioned properly for what's ahead and will continue to produce the returns that we all want. We thank you for your trust, your steadfast outlook as investors, and for the investment values we all share. On behalf of everyone at Newport, be well and safe in the months ahead.